Hey traders, it's Leaf West. I'm going to make one last video here on red and green candles. And much like I described in the yellow candle video, video number 4, I think it was, you have to use the color-coded candles in context of patterns to really get the best use of them, to make the most leverage out of using them. And that's a good example. That's a good proxy or statement to have for intraday trading based on flipping from long to short or from neutral to long, what have you, based on the color coded candles. Say for example, this is Freeport 3-minute chart. So that's what I use for intraday trading. So we've been having a couple days. This was from the 18th. We had a couple days earlier of Freeport doing well, and the day before kind of consolidated sideways. But anyways, the next day we open up slightly lower, can't take out the lows, and then we break the swing high here. So to me, this is a bullish setup for the day right early. So if you weren't watching this stock right at the start and you came to it afterwards, that would be my quick assessment: is that you broke a previous sort of consolidation rectangle that we made at the end of the prior day, and you're making higher lows on your candles, and away you go. So you get to a point where your price starts to consolidate. So this is where you look to possibly use the color coding just to trigger you long or trigger you short, what have you. And in this case, it would have been a long because you had bullish action, and now you're getting consolidation. So now you could again, you could just draw a trend line and say, okay, well, what are we doing here? Well, you're kind of making, you're making a rectangle, kind of almost, right? But the idea is to, again, I don't like on one red candle. What I like to see is at least a couple of red candles before I were to use it for a color-coded trigger. And what I'm finding is probably makes the most sense is that when you are getting triggered long in this example, I would wait till the break of either the moving average, or I find breaking of the high of the second candle, the second green candle. And in this case, the high of the second green candle is a little bit higher than the first candle. And if it weren't higher, then I would use the high of the two candles combined as my trigger. But in this case, it was slightly higher. It was 43.68. So on the break of that 43.68, that's where I would get long, and I would have my stop below the low of the structure, the pullback structure. So my stop would have been sort of maybe 45, 43.45. So I would have gotten long, that would have been my trigger to get long at 68, and my stop was 45, so roughly 23-cent stop. And Bob's your uncle, away you go. And again, here's another example: a bullish expansion. Sometimes when you have that big of expansion, you're going to get a little more than a simple little 3-candle correction. In this case, you didn't, though. I don't think I would have necessarily taken these a second green candle trigger here, because of the size of these bars. They're a bit too emotional for my liking. Here you had a shooting star kind of doji top here, and your trend strength is decreasing. So I don't think I would have taken this trade. Um, this was a different trade here, in that trend strength was actually rising, coming from a low spot and rising. You had a nice consolidation pattern. Here you had a little pullback and then some big emotional candles. So I don't think that's a smart one. And then looking at this from the other's perspective, this is that at the end of the day? Yeah, this is right at the end of the day. But if it weren't at the end of the day, well, you may not have had a move like this. But to me, here you've had price making new highs, trend strength gotten weaker and weaker, and I think you're going to have a bigger corrective move. So I would be looking at this possibly if you want to play aggressively, you want to play a short. But again, the bigger time sense is that this trend is higher on the stock, so playing it the other direction is tricky. It's aggressive. It's really aggressive. But normally, what you do then is you get red, but you don't short this because you don't know when you're going to get a corrective bounce. And it's the second set of reds, it's the red to green to red. So like the opposite to this other one was you go green to red to green and get long. When you try a short, you go red to green to red, and it's that second red candle that you the second set of red candles that you get short on, and that was the first candle of the day, and it opened up below the previous highs and sold off pretty hard. But again, because the bigger trend is up, it gathered strength. It had price extreme, bounced, and then give you this nice little pullback. That was I wasn't watching the stock at the time, but that was a really nice looking consolidation after a very bullish stock in a bigger time sense did a little flash, sell off like that. And then this is getting trickier, but if you look at this, that's a pretty bullish projection of going lower. And then we're consolidating, right? We're consolidating. So again, now we've pulled back into red. It isn't really a recognizable pattern. It's really just a pullback. So then again, at first trigger for me here would have been the breaking of the second candle's high. So the second candle's high was 44.58. The stop would have been around 44.17, 16. So 30 cent stop, and I think I would have closed out my trade here on the breaking of the moving average, because we really didn't make a meaningful new high. When you go up like that and then you fail right away, it's not a good sign for a break higher. So there's a good example. And so on the short side, we had again a failed break to new high, and you have to remember that this was a lower low, so you could say that this was a setup for a short. And if you're going to do that, then what is it? It's the red to green to red. So in theory, the breaking of the low of this candle right here, the 44.61, that would be my trigger, my fail-safe trigger there, right? And your stop is above this high, which was 44.74. So say 44.76 or something like that, and your trigger was 61. So it wasn't a big stop at all. So the risk reward's pretty good on this one. And then you would have, I think you would have got stopped out here at 45. So you only make 15, 20 cents. But again, you can always play the short again if it sets up for you. Again, on smaller time frame charts, you're going to get whipsawed more. So this is a bigger time frame. It's a bullish chart, so it's very tricky playing short on a smaller time scale. But you did get some follow through. This is on Friday. You got some follow through for sure. But it was OPEX day. So now you've got a downtrend for sure, and now you've got the counter trend bounce. Right, so you go to green, so you're making lower lows, so any bounce higher is a short, right? So the place to short would have been on the second candle, the first candle or second candle, but I think the fail-safe one is the breaking of the low in the second candle, and that was 43.16. And again, you only made 15 cents there before you got some price extremes and you got a bounce. So these counter trend moves are really tough to play. So, but that's how. Let me get one more example for you guys. Okay, this is the Spiders 3-minute chart, and this is January 18th. So here you had again similar with the Freeport. You had an open that was that failed to push lower, and then broke that late afternoon swing high. Gave you a couple of warnings that this was a kickoff move higher. Made an extreme candle warning, so we're telling you that the trend has to at least correct or consolidate after in this area. And sure enough, we get that pullback. And again, I like to see a little bit more red candles before I believe the move back to green. And I like to see completed patterns. So I don't know if you could almost say your fail-proof way is to draw a trend line, and you didn't actually break this trend line here on this red to green flip. And you could have argued that, okay, now I've gone red to green, and that you could have got long on the break of this second candle. But the first candle was higher, so you'd use that as your break point, and you didn't actually break it until you came over here on this candle on this side of the reds. So there, again, yeah, there's some art to watching these candles and knowing when to get triggered. Again, I like to see the pattern colors used in conjunction with patterns from price patterns. And then here you had an obvious pullback pattern. And so the most conservative point is to wait for the trend line break. And if you're willing to get long earlier than that, you have to give yourselves a big enough stop to avoid getting whipsawed. And even if you did get whipsawed, you've got to remember that the bigger pattern here, the price pattern, is that price is breaking higher, and so then you should have got long here on that. So here you've made a new high on the price structure, and you've pulled back and you've made red candles. Okay, and you made sort of three sort of matching lows on those red candle pullbacks, and then again, whether you get long on the first green candle, long on the break of the trend line, or long on the break of a second candle's high, is all up to your preference as to how you want to trade. And in this example, the more information you want, the more confirmation you want, the bigger your stop's going to be, right? So the bigger your risk, the bigger your risk is relative to your reward, because you're getting more information, more confirmation that the trade is going to work in your direction. So again, at the start of the day, these red candles are a little more tricky because you get some emotional back and forth. But later in the day, when you're obviously trending higher, the spot to trade is to look for the flipping of green to from red, and that was the case here. Again, the bigger chart told you that we're getting into an area of resistance, so you have to use that in conjunction. And here is a perfect example of, you've made a lower high, you've pulled back, made a lower low, right? So you have to be suspicious of a counter trend move in the other direction. So if you're being aggressive, you could say, once you made this lower low, I'm going to go short for a quick scalp on this flip from green to red. So it was the breaking of the second red candle, or the breaking of the first red candle, or the breaking of the trend line, where you went short and your stop would have been above this structure high, so it might have been around 52 cents. So you're okay, even on that little pop there, you're okay. And you made a little bit of money, but it really was just a consolidation corrective pattern here. And when you broke the trend line, you could argue that this correction was over on a bigger time frame sense, right? So then you could have said, okay, when I break this and I flip from red to green, I'm gonna get long, right? And my stop is breaking of this moving average. So you could have said, I've got stopped here for the trade, but you made another 20 cents, 18, 20 cents. And you could say, well, because we made lower lows here, when I go from green to red, I get short again, right? So red to green to red, you're making lower lows. And sure enough, you go, but you're making a higher low this time. So this is a bullish sign, right? Higher low. And then you say, well, my stop is on my short is there. And if you're looking at it from a long perspective, you could say that the bigger structure says that this was corrective. So all I'm doing is waiting for a move and then a pullback, and then get long on the second move to greens. So here's your first one, here's the correction, and then here's the confirmation that this trend is going that way. So here is the spot to get long with the green candles here again. And if you didn't catch it here and you got red and you flipped here, you could say, okay, well, I'm going to get long on the flip, get long on the break, get long on this break, and we move into the close on OPEX day. So lots of whipsawing for that perspective as well. Okay, that's good. I think that should help people try to understand better the color coded signals of the LeafWest trend tracking software. Okay,